Hey, good morning, everyone. Marty Mazzora here. It's Saturday, the 22nd of April, 2023, with your weekly economic update. I think you'll find this one to be quite interesting. Mixed would be the best way to characterize the current setup. Recessionary, for certain, based on how we see things and how our general conditions index scores. However, at the margin, better than what it's been of late. And I want to start with sharing some data that aren't inputs in our index, but are somewhat telling. We rose 2 points to 33 in our general conditions index. Now only 16% of our 45 inputs are positive, 49% are negative, and therefore 35% are in the neutral column. So I'm not here to tell you that, as some are telling us right now. In fact, I'm halfway through a really good podcast with a macro analyst who I have a great deal of respect for, who is skeptical as to whether there will be a recession in 2023. He qualifies it, implying that there may be one in 2024. So it may be a matter of timing. And I think he contends that anything we get would be of the mild variety. So as I continue to stress, and I tell friends who are investors or traders on their own, that just never ever wed yourself to any thesis, and do not reject those theses that conflict with your own. In fact, I would say spend, if not more time, at least as much time, exploring the arguments that are in opposition of your own argument. Then you're being objective, then you're not tying yourself to any outcome, and then you're being smart and humble and realistic, because markets can surprise you, and there are too many moving parts to be able to really know everything that's going on and have it in the right perspective or the right context. So that's why we work so hard day in and day out at this stuff, to at best come to conclusions on the present risk-reward setup, where the risks are, hedging against those risks, diversifying, where the rewards are, time horizons for those rewards, and the current risk setup there as well. At the end of the day, making certain that we have as good a handle as possible on the global risk-reward setup, and then allocating assets accordingly. Okay, so as for a real positive sign, again, this is not one of our inputs. We use the Institute for Supply Management, Purchasing Managers Indices. This one comes from Standard & Poor's. You can see we have data back to mid-2020-ish. And the yellow line is the Services Purchasing Managers Survey results from the latest survey. The white is manufacturing. And you've heard me say that manufacturing has been in recession for several months. Well, it's now back in expansion. And contraction and expansion is separated by an opinion score above 50 when they net it all out. Services, which makes sense as you've been out and about, people are spending money on services, experiences, and so forth, it still sits at a plenty high 53.7, with the nice margin between recession and expansionary conditions. And it makes sense that manufacturing would roll over, particularly given where we've come from post-COVID and so forth. And then services would follow. So we do have an uptick. And one thing about the PMIs too many people forget is that it is purely a month-over-month phenomenon, meaning manufacturing conditions are dramatically worse than they were a year ago. No ifs, ands, or buts about it. But they've improved from last month's survey. Okay, so if it's about, so let's say the previous month was down to 40, which is just scary low. Here it was, during the COVID situation. And then we get this big bounce. I remember when this happened, we got this big bounce and everybody's, oh, look, we're back in great expansion mode. Well, no, we're bouncing off of historic lows, right? It's a increase from last month's horrific numbers. You go further back and we're not even close. So we always have to remember that. And even the stuff I'm reading about the S&P PMI suggests that some of the narrators are missing that important point. Nevertheless, we are above 50, and it's something we should pay attention to. Now, when we dig into the weeds of that survey a bit, thank you, Peter Bookfar, an analyst/economist whose premium work we pay for, and he does a good job parsing through a lot of things. So if we're not inclined to read all of a particular report, more often than not, folks like Peter will give us a nice synopsis, and that they or their people will go in and do the work. So as long as we trust the source, we're okay with that. So here's some of Peter Bookfar's commentary on the S&P PMIs. He titles this piece, "To Confuse Us Even More." So the first time since last October, S&P's U.S. manufacturing PMI was above 50, from 49.2 last month. The services component was up 1.1 points to 53.7. The composite, when you combine the two, is now 53.5. Of course, that owes to the strength in services. S&P said it was helped by greater employment and stronger demand. New orders rose for a second month, helped by improved marketing initiatives, greater domestic demand, and the acquisition of new customers. Here's the part that we need to be concerned about, because we want to be careful to not run off. Let's say our own PWA index just starts moving back toward the positive before we actually have a recession, before we actually see stocks at a minimum test those 3,500 lows. Because remember, the 3,500 on the S&P, which is where we hit, was our call from the beginning of 2022. But it was predicated on no recession. I said if we do have recessionary conditions, we're highly likely going to go lower, which is still our base case. But if suddenly our index went in the green and we didn't have a recession, then 3,500 is still our target. And I would be blown away if we don't at a minimum test that, particularly if we don't get our recession, because from the report, inflation pressures rebounded as, quote, the rate of cost inflation quickened in April. The pace of increase was sharper than the series average as companies noted that higher borrowing costs and general inflationary pressure added to business expenses. The pass-through of cost pressures picked up too, quote, as firms responded to higher cost burdens by passing these through to consumers where possible, amid more accommodative demand conditions. So I can go on and give you some of the details and you'll see more of a mixed picture, but I think that's the one that's key in terms of my message here this morning. And that is that if indeed we turn optimistic on the economy, it's probably going to be very problematic for the stock market, because if we don't get our recession, you're going to hear more of what I just read about higher costs and inflation. And we know how unpopular that is politically, and we know what the Fed keeps harping on. So it's almost like this doesn't end until we get our recession, until we break inflation's back for a while. And then thereafter, until we accept that this world we live in today demands higher inflation for longer than we've gotten used to the last 2 or more decades. And that's just an inevitability. And we've written a lot about that. We haven't in a while, so we'll revisit those narratives and our thesis there, I'm sure, and update it to present conditions and so on. But that's still very much our base case. So kind of a catch-22. If as some people, as the gentleman I'm listening to right now in this podcast this morning, is right, and either it's super mild, if any recession, 2024, 2023, what have you, if it's no recession, then we don't get to the 2% inflation target, and the Fed's just going to have to go back to pretty severe tightening. And that probably is very problematic for stocks. Recession, our base case, mild or otherwise, earnings are going to come down, and then that's your next leg, lower. Time will tell. We aren't wedded to any of it. We're just daily trying to figure it out for ourselves and protect our clients' monies accordingly. I thought about getting into the whole debt ceiling situation. No doubt we'll have to going forward. Looks a bit more serious here than it has in the past. I think there's a lot of complacency. I absolutely share it. The notion that the federal government in the U.S. will default on its debt is a very, very, very low probability notion. And if it happened, it would be so temporary. And the comeback from that would be so swift and so extreme because of the global economic ramifications. But the two sides are deeply divided, and the balance of political pressure and power and so forth lends itself to a problem. Now, I didn't pull up anything to illustrate this, so I'll just give you kind of an appetizer of what we'll probably be talking about in the coming weeks. And that is, within the Treasury markets, we're seeing some interesting things in spreads, for example, between like 1 month and further out, say 4, 5, 6 month Treasury bills. In fact, record spreads, meaning the 1 month T-bill, the yield has been plunging, certainly relative to further out months. And there's issues around collateral, potentially, that some people are really jumping on. In our view, it's probably much more about the simple fact that 1 month T-bills mature before the time where this situation could actually force a default on Treasury debt for the government. And again, the spreads would go berserk if something like that happened. It would be a buying opportunity in a big way at certain points along the curve. It would not be a permanent situation by any stretch of the imagination, but it could scare the bejeebers out of everything and everybody globally. So in a just-in-case position, you can see money rolling to the very short end that will mature before this thing comes to a head. There's dynamics around the precipitous decline in the Treasury's checkbook, the Treasury General Account. It's something that we track every single week when we do these exercises. I don't think I've talked about it much here on the blog, but for all intents and purposes, this debt ceiling has been hit, and any new debt they're issuing essentially is refinancing of old debt that's coming due. And in the meantime, to fund the government, Janet Yellen is having to spend down the Treasury General Account, and it is getting kind of scary low. And apparently not quite the tax receipts so far that the government had anticipated, from what I understand. And you have this kind of scary look that they literally run out of money here before this thing is settled as well. And then the catch-up issuance, once it is settled, means heavy new Treasury debt to pay for the deficit this year. And that has all kinds of implications on yields and so forth. I mean, when you think about all of that, it's almost like, heck, the Fed should get aggressive, force a recession, get yields really, really low, and give the Treasury the opportunity to issue that debt at a low enough yield. Otherwise, with the economy maybe coming back, some people believe inflation, therefore, as I just read to you, coming back big time to the fore, and that's problematic as they continue to roll old debt and issue trillion plus this year of brand new debt. So a recession would be actually convenient and timely if they could pull it off, at least for that particular purpose. So let's just put it this way, folks, very precarious setup. And, I know a lot of you watch this and you think about the equity markets, and I appreciate that a few of you like the technical analyses that I do. And you could wonder, in our overall pessimism about or concern about where stock prices are ultimately going before this bear market is over, how's it staying so buoyant? And then we can get into a whole other conversation about the fact that people came into this year like us really expecting the market to sell off, and obviously we still do. But if you allocate to that and if you hedge to that and so forth, ironically, the activity of hedging portfolios actually, believe it or not, ultimately lends itself to supportive areas of the market. I've talked about put walls and call walls and this sort of thing on other videos. And so it's almost like you need this capitulation. The fact that the VIX is getting so low here that is kind of a red flag, among other things, that maybe some of that support's beginning to wane. I was talking to a good friend of mine yesterday, and I said, when this second leg of the bear market or last leg plays out, it'll be right after we decide it's not going to happen. And I say that facetiously because if general conditions tell us the risk is there, we're going to continue to act as if it's there. But people who just trade this stuff could easily capitulate because it's been a rough year. You may have a very solid thesis, but if you're trying to short-term exploit it, and I've seen this, we've been here before, it's been tough. And I think a lot of those people are just going to give up. And it's when they give up, ironically, that the support goes away. So again, all of this remains to be seen. The surveys are saying things are looking up again. However, with regard to markets, problem is, so is inflation. The other thing there is I mentioned during the week on the blog that the Empire State, the New York Manufacturing Index rebounded sharply to plus 11 from a minus 25. I talked about that, or I wrote about that earlier this week. It was that post that I said, let's start with a little positive news for a change. The 6-month business activity outlook rose 3.7 points. And speaking to inflation, expectations for both prices paid and received rose as well. Now, just to give you the counter to that, talk about mixed, the Philadelphia Fed said its April manufacturing index fell the 8th month in a row below zero, back to the depths of March 2009, not including COVID. Was the last time you saw reads like this. I'm reading again from Peter Bookvar's notes. The 6-month outlook was less than zero for the second straight month at negative 1.5, which compares to a negative 1.8 in the 6-month average. Capital spending plans were negative too. So you got the New York survey saying things are bouncing all of a sudden, if not booming. The same month, the Philadelphia survey says things are in the gutter, hence the characteristic of mixed. Okay, now I'm going to start going fast. So looking at retail sales, these are the things that are inputs to our index, continues to look ugly. The one that we get each week is the red book. You can see it's just continuing to decline steadily in terms of rate of change. And that is just obviously a negative look, to put it mildly. Mortgage purchase applications ticked down a little bit. Again, we're definitely seeing some life in the real estate market, which I'm going to talk about more on in here in a second. But down 10%, 161. So that would be confirming the trend, if you will. Housing starts and permits came out this last week. Now, housing starts overall actually ticked down a bit. Now, our primary focus, though, is on single family. And we're seeing a nice move higher in single family starts, right? In terms of permits, actually a big up move. Now that speaks well for starts going forward, of course, because permits obviously precede starts. And it was, all of it, I think, was single family. So like, for example, in the starts, you saw it decline overall. Well, that means multifamily, which has been absolutely on fire, is rolling over a bit here. So multifamily was down. It's that single family was higher. The home builder sentiment index or the housing index kicked up a little bit. Still contractionary, still low, but the direction, right? We need to pay attention to that. And I get how people like the guests in the podcast I'm listening to aren't so dire right now. This one really bothers me because, we've done a lot of work on this, and it's not hard to do the work if you just do the optics, right? What happens from any level when weekly jobless claims begin to pick up? Well, that tends to be what happens, and those red areas are recessions. Continuing claims saw quite the bump. I think it was 50,000 week over week. Truck tonnage really rolled over hard. This is very consistent with one good friend I have who's very much in that space and very intimate with the details there. He's been telling me of this for quite some time, even though it's been counter trend. So that would be obviously not pretty in terms of what it says about the economy. So this one for us folks is such a high confidence indicator. you could just look at this to gauge recession risk. This is the ratio between leading economic indicators, things like average hours worked, weekly jobless claims, manufacturing new orders, the ISM stuff we look at, capital goods, building permits, yada, yada, right? M2 money supply, yada, yada, and consumer sentiment. Coincident indicators are non-farm payrolls, personal income, industrial production, and the manufacturing sales. So this tells us what's going on. This tells us what is likely to go on, right? So the leading economic indicators. In fact, if you want to look at them individually, we just do this. And you can see that the coincident indicators, month over month, actually improved, but the leading indicators continue to roll over hard, right? So as you can see, the look heading into recession, right? And folks, you may recall we were doing these videos and we were pointing to these, and all the while our PWA conditions index was in the green. So I was telling you these are just pullbacks in the context of an ongoing expansion. Right here I was telling you this is the real deal, because our PW index turned red in August of 2019, and we did get our recession, and I think that was coming. The fact that it was COVID made it deep, but the fact that it was COVID and brought all that stimulus to bear made it almost not even happening. The deepest recession in history, the shortest recession in history, right? Well, here we are, folks. And again, when you look at this and you look at the past, right, and we're in the red big time in our index, you understand why we think it's highly likely that we're going to see a recession. Now, remember when I had fun with Wile E. Coyote cartoons here recently, what I was doing was I was including corporate earnings, S&P 500 earnings, and telling you that they should be falling with these recessionary conditions. And when I showed that, they hadn't yet. Well, they are certainly beginning to. This would be Wile E. beginning his descent to that bottom of the canyon where that puff of dust ultimately hits, right? And so this also would suggest stocks should be rolling over, right? That's our base case, is that this is the wake-up call, and this is going to be the nature of the second leg down that is consistent with what goes on during recessions, right? That first leg brings you to a certain level, and the next leg happens with this, right? Well, let's actually fold in the S&P 500 and see what we get. Now, this is interesting, right? So the blue line is the S&P 500, and here earnings are rolling over, and here's the S&P actually going up. Well, we've seen things like companies issue layoff announcements and watch their stocks rally on that news, right? So I think it was Lyft here yesterday, and I believe their stock was up. It's not a stock that I track, but I do remember either seeing or hearing that the stock was up noticeably. I heard that they were laying off 1,200 staff. So the idea is, well, the earnings are falling, but they're going to lay people off, and that's going to help the earnings. So therefore, we should get ahead of that. Also, frankly, it's what the economy. Save for the positive data lately, it's what the economy is saying, that recession's coming, and if recession's coming, the Fed's going to cut interest rates, and the Fed's going to cut interest rates, well, then stocks, of course, are going to go higher. And that's what the market is getting wrong, as I keep saying, is because if we're in recession and the Fed is cutting during this recession, stocks are getting creamed, right? Because earnings are falling to the floor. So that narrative that, hey, the worse of the economy, the better stocks because the Fed's going to cut, no, not at all. If we have a recession, earnings are going to the floor, and the Fed's going to be cutting amid a bear market, if history means anything at all. So that's a good one to close it on. You get the picture. Very mixed, but net negative, from an overall economic look here in the U.S. and globally. There's pockets of strength globally, and there's some pockets that we're actually willing to scale into even now in our core portfolio in different parts of the world, because there's setups are different there. There is some bifurcation, country by country, region by region. But right now here in the U.S., good-looking stuff today worth talking about, right? The S&P's Purchasing Managers Index, certainly the housing market coming back a bit, is encouraging. So we want to pay attention to that. We want to look for sustainable or durable trends. We don't know that we really have anything that would have us join the bull crowd right here. As you can tell, we don't. But we're open to that possibility, so we'll keep doing it day in, day out, week in, week out, and reporting to you as we go, and clients allocating your assets accordingly as we see the world today. Thank you, folks, as always, for watching and listening. Hope you have an awesome weekend. Talk to you again soon. Bye-bye.